Hello and welcome. This is the Insurance ProBlog Podcast. This is episode 438. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance. An incredibly complicated technical life insurance analysis.
Ooh.
Probably should have left that one out for now.
Now everyone stop listening.
Yeah, retention on this one's going to suck.
No, but I actually think this addresses it. It is sort of technical, but it addresses an issue that comes up for people who own index universal life insurance.
Yep, it does. So if you own or you're interested in buying index universal life insurance and you're looking at all of the index options going, what do I do? We have answers.
Yes, we do. Stay tuned for those answers. We're not going to give it to you now.
No. Can't do that. We gotta weave the story.
You got to listen to all the ads we don't have.
As you take. Oh yes, this podcast brought to you by. As you're going to the skip forward 15 button and hitting it vigorously. No, there's a little bit to cover in terms of how we get to where we're going, but it's important.
Mm-hmm.
This one is totally us being us.
Yeah.
So.
Hey,
you come.
What else was I supposed to do on a Saturday morning?
Exactly. You come because when you have esoteric answers on super, super refined insurance minutia that obviously the internet and AI included are not going to be able to answer, that's when you come to us because we spent the time that no one else will, for whatever reason, to get to the bottom of this.
There's nothing like a cup of coffee on a Saturday morning and do an empirical data analysis. I don't know. Warms the cockles of my heart somehow.
We do it for the fives of people who have asked this same question.
That's right. So let's jump in.
Yeah. I guess that was my cue to do something.
So here's where this originated. Yeah. I was having a conversation with an existing client of ours. Mm-hmm. Policy anniversary's coming up. Which index should we stay put in the index option we're in? Should we look at another one? This and that and the other. Yep. That was a conversation. So I answered the question. We talked about it. Everything's good. No issue. But it just got me thinking, like, because we kind of have our, I don't want to call them standard answers, but we have our answers that we worked out years ago, based on our analysis. And so I wanted to revisit things because there's a lot more complexity in terms of the number of index options that IUL contracts have than they had 13 years.
Yep.
So that's where this came from. And so what I did was, and I realized there are countless numbers of index options. Some are proprietary to particular companies. There are probably hundreds, if not more, of different ones. So I just picked the two that are pretty standard across, I wouldn't say every company, but most companies that have IUL products. And that is the standard S&P 500 index annual reset with a cap. Very simple and easy for people to understand. And then the other one is an uncapped strategy with a spread. So let's say a contract has a 100% participation rate with an 8% spread. So that means if you got 20% on the index for the policy year, then minus the spread, you earn 12%.
Mm-hmm.
Pretty straightforward in terms of being able to understand how they function.
Yeah.
They're not complicated.
So very, very traditionally, the capped option, the annual reset one, you already mentioned, says, look, you get the movement in the S&P 500 up to some limit. Right now, that average is somewhere between like 8 and 10%. Right. So whatever the market is, up to, if it's an 8% gap, then it's 8%. So if the market's up 13, 8% is the number.
Yep.
The uncapped option says, well, we're not going to put a cap on it, but we are going to refine it. So spreads are one option, or some different participation rate has become a little more newer, the way that a lot of people are doing it. But looking at it with spreads, a spread is just a reduction. Yep. So no cap, but we're going to minus some number from whatever the movement is. So in your example, if the spread's 8%, market's up 20%, 20 minus 8 gets us 12% being the interest paid on cash value.
Yeah, but the flip side is if it did, like you said in your first example, 13, you're going to get 5.
Yep, correct.
So you look at those and go, well, the regular old capped option would have been better than the uncapped option. So how do you choose from year to year?
Right.
And of course, I overcomplicated it initially. Like, well, what if the market dropped by X the S&P has fallen by X% over the past year? My hypothesis, I guess, was, well, clearly that would make the uncapped option better, right? Because the market tends to whipsaw.
You're looking for a mean reversion.
Yeah.
The thought process
is a fancy way of saying whipsaw, yes.
So if we have a big reduction, we're expecting that year to year, we're not talking total return here, but if we're segmenting it. So if the S&P 500 goes down in 1 year, let's say 25%, the expectation is in the following year, the upside to that, because it's just rebounding, could be quite substantial. Could be double digits. Could be up 20%.
Right.
If you're invested in the market, you're not positive. But if you're segmenting this in index universal life insurance, it could be a very good thing. But if you're capped at 8%, you don't get a lot of that.
Because we have because with IUL, unlike investing in the market in the S&P directly, with an index universal life contract, you have the annual reset. So you get the new number. Wherever the level is at the beginning of the policy year is your starting point every year.
Right. So the initial analysis here, and the world of computation at our fingertips has vastly improved over the past couple of years.
Yes, it has.
So we have more tools at our disposal as long as we can find the databases to feed into the tools.
Yep.
And when it comes to market data in the S&P 500, the databases are plentiful.
Yeah.
So looking at this and saying, all right, if I have two options that I need to choose between, one is an S&P 500 index that has a cap. The other one is an uncapped with a spread. Which option is going to give me the best result given those two options? And let's use some time frame to sort that out. So the last 20 years, tell us what would have happened if we chose one versus the other.
Yeah.
To try and decide what the correct decision is moving forward.
Mm-hmm.
And what we see is there's definitely an answer. The answer in terms of the difference is not nearly as mind-blowing as you might think.
Right.
Remind me what the cap assumption was.
8
here.
8.5%. Sorry.
Okay. 8.5.
Yeah.
Okay. So we would basically, or I didn't do this. You asked for 3 scenarios to identify the optimal approach.
Right.
One was 100% capped, 100% uncapped, or speaking to your whipsaw example, what if we stuck in the capped option, but if we had a year where the market went down 15% or more, we would allocate to the uncapped option at that point, expecting that would be able to surge back and we'd be taking advantage of that movement without the capped feature limiting our return from the whipsaw.
Right. Yes.
Okay.
Now, the interesting data point that arose that I hadn't really considered after using, because the 15% number was completely arbitrary.
Yep.
It wasn't based on anything. It was just arbitrary. In the last 20 years, there were only 2 times where that happened. So, which is kind of remarkable. I was like, really? Yeah. Huh? Yeah. Yeah. That's true. Yeah. Sorry, I interrupted you. But
nope. I was just going to say, so that analysis told us that the uncapped option is the winner in terms of absolute highest return on cash.
Right.
So
that was starting in 2025 or 2005 through, and I did current dates. So I did, beginning of September.
Gotcha.
2005 to end of August 2025.
Okay. So that shows us the uncapped option is the best accumulator in
over
that time frame.
Yeah.
But if we roll everything back 1 year, the capped option is the winner.
Right. You went 2004 to 2024, the capped option won.
Mm-hmm. And what we see is that this change the allocation aspect, it sits in the middle. But as you mentioned, the number of times it actually triggers is small.
Right. Now you could bump that down and maybe things would work. I don't really know. I didn't want to do an infinite analysis.
Yeah.
It was enough for us to do a half-baked podcast, and that was good enough for me.
Tell me how moving in increments of 0.25%.
Right.
How many more triggers can we get? Give me the optimal. Yeah.
I'm charging by the hour if I'm doing that level of analysis here. This was just a thought exercise to me that pointed out some pretty interesting things.
Now, one of the very interesting things here is that the total difference as we rank these things is small.
Yeah.
Like 1.2% difference in terms of
not
total
per
cash.
year.
Like whole total. So yes, the best option is the uncapped, but the win is like $25,000. Something
like that. Yeah.
So
in this scenario we used, because we assumed like a $640,000 cash value at the start.
Yep. So, it's not a big difference,
right?
In terms of where you fall. So ultimately, you could make either decision. Your life doesn't change,
right? But there's a third, more interesting.
So you brought this to me, and I just sort of off the cuff said, so if you just split it 50% uncapped, 50% capped, you'd probably get something in the middle, and it matters even less at that point which one you chose. And you said, well, I'd like to do the math. So you did it.
Yeah.
And this is where things get super duper geeky and interesting. Because
now we're in our sweet spot.
Yeah. So technically, actually, that's not even going to work, is it? The 50-50 model works, but if we're trying to optimize risk-adjusted rate of return, 55% capped, 45% uncapped is the chef's kiss of highest return, lowest risk of volatility.
Right. And it's kind of interesting to even talk about volatility in an index universal life contract, because it doesn't really mean much. Unless you wanted to start tapping the cash at some given point, I suppose.
That's a good point. That's actually a very good point. And we should spend a minute or two elaborating on that, because that's something that I think takes a very deep understanding to really understand the significance behind what you just said. So when you're taking distribution,
please explain to me what I just said, because I'm not sure that it was didn't sound that profound to me, but okay.
When you're taking distributions, the volatility of your year-over-year earnings matters moving forward.
Yes.
Because the higher the volatility, the more chance, the more risk you have of, in essence, running out of money.
Right.
Which is a weird thing to say with life insurance, because it doesn't quite work that way, but there's an analog to that. So the risk increases that you either have to change the amount of money coming out, or you are going to run out of money.
Right.
And so the lower volatility, the more confident you can be in the distribution amount.
Right.
Without any need to change or the worry of running out of money.
Right. And I should have said this in the beginning. I assumed a 1% floor, a 1% minimum.
Yes.
So in the event that the index returns for the year were negative or less than 1%, you got 1%. So basically, and the reason I bring that up now is because that's important to point out about the volatility. Essentially, what we're saying is the middle road option, or the 50-50, essentially, the 50-50 option of uncapped to capped in your cash value, will provide the fewest number of years that just hit 1%. So the maximum number of years that you're going to have something above 1%.
Yes.
That's where volatility comes into play here.
Yep.
It's never volatility in the sense that you're going to have a negative 30% year and then a positive 50% year. That's not going to happen.
Yep. Correct. Now, interesting numbers as they unfold. Mm-hmm. So the difference between 50-50 or 55-45 is like less than $2,000. Fewer than $2,000. If
it's insignificant.
Yep.
It's like, a rounding error.
Yes, there is a more optimal one. And again, the 55 capped, 45 uncapped is reducing the number of years you hit zero, and it's reducing some volatility. But ultimately, they're both really good. They're both very low in terms of volatility.
Yep.
Here's what I did not expect. So the difference in cash, as I mentioned earlier, between 100% uncapped or 100% capped was like $25,000.
Mm-hmm.
So the lazy, simple math assumption is, well, if we chose a 50-50 split, that means we'll fall somewhere halfway in between those two. Nuh-uh. The 50-50 or 55-45 split, they come in at like $4,000 below what the 100% uncapped option did.
Right.
So splitting it reduces a significant amount of volatility while also drawing results very close to the optimal, just 100% one or 100% the other.
Yep.
So the exact split isn't so significant, but splitting definitely gives us exposure to both worlds and taking advantage of both things while creating ultimately more return than the less great option between 100% one or the other.
Right.
And we got to speak for a minute for something that most people are going to hear and go, well, that's great. But this is significant. It's very, very hard to quantify and totally understand, especially if you're somewhat new to this. But we got to speak about the volatility thing.
Mm-hmm.
Because this analysis did a great job of calculating Sharpe ratios for us.
Right.
Because we were looking at risk-adjusted rate of return. And looking at these scenarios where we split either 50-50 or the 55-45, we have a Sharpe ratio in both cases that's right around 1.7.
Right.
Comparatively, the SPY or the VOO over a similar time frame, they're more like 0.6 or 0.8.
Right.
The higher the Sharpe ratio, the more return you got with less risk.
Right. And in our scenario, the 100% capped rate would give you the lowest risk.
Yep.
And the highest Sharpe ratio.
Mm-hmm.
So that's just to put it, I'm not saying that makes it better. I'm just saying the perspective.
Correct. So we have said it for like 14 years now that index universal life insurance is not additional exposure to the stock market.
Right.
It's a non-correlated asset, just like whole life insurance is. Because even though it follows, for the most part, the stock market, it has several different elements at play that substantially diminish the risk.
Yeah.
That is typically associated with a direct investment in the stock market.
Yep.
And this is that claim quantified.
Right.
The risk-adjusted rate of return here is much, much higher than what you would get just investing passively in the S&P 500. Now, I have to be very careful and point out that I need you to not hear what I'm not saying, or I don't need you to hear what I'm not saying. I'm not telling you that putting your money in index universal life insurance is going to get you more money than investing in the S&P 500. I'm simply telling you that the number of times you're going to get an upset stomach owning index universal life insurance will be fewer.
Right. I agree with that. And to me, the most interesting part of the whole thing if we go, and I have a chart in front of me, which is helpful for me to visualize this, but the way this chart works is it goes from 100% capped option being the highest Sharpe ratio or lowest risk option at the top of the chart, and it steps down by 10% increments.
Mm-hmm.
And so it switches, when it drops 10%, then you're adding 10% to the uncapped. So they converge and diverge. The 100% capped option over the last 20 years, ending in August 29th, because that was the last market day of August. The return was 6.68% per year.
Mm-hmm.
That was assuming an 8.5% cap. Now that's another variable we didn't talk about. I can't assume different cap rates all over the place because who knows what they are, and that would just be random.
Yep.
The cap rates fluctuate, spread rates fluctuate. None of that stuff is static. But it was assuming the 8.5%. It was a 6.68 annual return. The most risky, I'm using air quotes, which is always helpful on a podcast, being the 100% uncapped option.
Yep. Gets
you 6.75%. In real dollars, we're talking, and this is in all scenarios, we're at over $2.3 million.
Yep.
And the least risky option, the 100% capped option, is 2.325.
Mm-hmm.
And the most risky option is 2.354.
Yep.
So 1% total difference.
Yeah.
Roughly.
Yep.
So look,
if you're looking to squeeze every nickel, we have an answer. We can do the analysis.
Yeah.
But if you look at this and go, well, good enough is good enough.
Well, after all this deep analysis, at the end of the day, my conclusion was it doesn't really matter.
In this case, no.
It matters. It matters in terms of volatility.
Yeah.
Because I think that matters to people psychologically. Having done this for a very long time, no one likes a year where they just get 1%.
Nope.
Or zero. In a lot of contracts, it's zero.
Yep.
Nobody likes those years. And I'm going to tie this all back into the psychology of what we've discovered about these contracts. And that is they only work if you follow through with what you're planning.
Yep.
So in other words, if you get disheartened 5 years in and stop paying the premium, it's definitely not going to work.
Yep.
Not going to work to the level that you were hoping it would. So
there are adjustments that can be made to maximize that new reality, but you're never going to see the numbers that you originally saw that assumed you were going to pay a lot more money into the policy.
Right.
That is very true. It's also interesting to note that in these scenarios, you said 6.68 or something like that, 6.7 being the we can think of them as the average index credits.
Yep.
Which is substantially higher than anything we assume.
Yeah, absolutely.
And we've been advocates of subdued expectations from the beginning.
Yep.
Knowing full well that the history supports a higher number.
Yeah.
But we look at that in a couple different ways. One, if the higher number materializes, happy day, we have more money. Two, we need a contingency for the fact that things could change.
And
we've lived through cap rate reductions. We've lived through spread increases. All that stuff.
Yep.
Has not changed the original expectations we set for the policy.
No.
So that's part of our logic behind using lower numbers.
We've seen, I mean, I don't think I'm exaggerating. You correct me if I am. We've seen cap rates. They're not currently at 50% of where they were when you and I started working together, but they got there. Some got there. Some got less.
Yeah.
Even less so.
Yep.
Some were slightly more, but we've seen 50% plus or minus reductions in caps. Not instantaneously. It wasn't like they snapped their fingers and went from 14 to 7.
No.
But there was a slide. And we've seen things come back up. Not to the levels that we saw when you and I first started working together 13 years ago. But that's, and you have to account for that variability in your assumptions.
You do. And I mean, to paint the picture here, so 8.5% cap rate shows us 20-year history of the S&P 500 still creates a 6.68, was it, you said?
At the top, yeah, the capped.
Yep. That's the capped guy. So 6.68, yep. We still average out like, actually, I think it's 6.7. No, I'm looking at the wrong one. 6.68. Yep, that was correct. So 6.68. There was a time when these cap rates were more like 12%.
Mm-hmm.
And our assumption was 6.
Yep.
We haven't used 6 on products like the one that we used to model this in a while.
Right.
But now that it's at 8.5, 6.68 is still a reality.
Yep.
So the fact that we assumed 6 when the cap rate was 3.5% higher,
right,
means that we've got comfortable margin.
Yep.
At 8.5, we still think 6%'s probably going to happen.
And we were doing that. I mean, not to toot our own horn, but we're going to toot a little bit. We were assuming 6 back when the default rates on illustrations, when you pulled them up, you didn't change them.
Yeah.
The insurance companies were all over 8.
Yeah.
And we looked at those and said,
no thanks.
I don't want to set that expectation.
No.
It's awesome if you get it, but
Yep.
It's not realistic.
And we've got some policies in force that have averaged something more like that number.
Yeah.
But I'm not going to build expectations on that.
No.
So in this particular situation, what we learn is that 100% of any one option is probably not the ideal.
Right.
Blending it a little bit is a good idea. The exact blend isn't going to matter a ton because the change in terms of risk-adjusted rate of return isn't huge. It could be 60% capped or uncapped, 40%. And the alternative, it could be closer to 50-50, 55-45. Those are all going to produce similar results.
Right.
We're not going to give up a whole lot of cash by virtue of that blend. We're talking about fractions of a percentage point over a 20-year period with respect to the difference in cash accumulation. But we are achieving a better risk-adjusted return. And then if we're taking distributions, we're headed into a world with lower volatility, which is a more ideal scenario. It just is.
Yep.
I've long said that one of the problems, the things that indexed universal life insurance has and struggles with, especially juxtaposed to whole life insurance, is the 0 year or the 1% or whatever it is, the year that the market's down.
Right.
Because it is a substantial change in the expected increase in cash value. And while the average over a long period of time makes it pretty much a moot topic, it still has an impact on the psychology of the individual. And it definitely has an impact when you're trying to distribute money.
Mm-hmm.
Because that changes the arithmetic a little bit.
Yep.
So anything we can do to minimize the frequency of that puts indexed universal life insurance in a much stronger position.
Yep.
And as you can see from this analysis, it's one of the ways, not the only way, but it's one of the ways we can go about accomplishing that.
Yep. I agree.
Okay. Good enough for today?
Yep, good enough.
All right. Then I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.